Hello everyone and a very warm welcome to this week's stock market update for June the 18th, 2026. First of all, I apologize for not having posted anything over the last several weeks. Our previous update was on May the 18th, I believe. We were out of the office traveling, and since then we've been really catching up on a lot of things we needed to do. And we have been nailing pretty much every low and every high since the recent all-time high in the S&P 500. So if you're not a newsletter subscriber, you've missed out on a lot. We'll go and review that. This video will be a little bit longer than usual, so you can see how we've exactly forecasted pretty much every single twist and turn in the market. So this is last month's forecast. All right. We were looking for a completion of a wave 9 and then a fourth wave and then a fifth wave. All right. Back then, May 18th, we thought we would see a B wave and then a C wave for a little bit lower to the ideal 23.6, 38.2% retrace. Well, unfortunately, we did not get this ABC lower. We got a very shallow wave 4. That happens. In bull markets, downside disappoints, but this was rather disappointing. However, we were, of course, looking a little bit higher, but that short there never happened, so to say. However, we, of course, were correct that this was a smaller fourth wave and that this fourth wave would then transpire into a final fifth wave to ideally 76.50, 77.20. That was the ideal upside target. How high did we go? We got to 76.20, I believe. So we were only off by 30 points on 7,650. That's nothing. All right. So we did bottom here for this wave 4 and we did get the wave 5. So indeed, we failed to accurately forecast all the nuances and twists and turns of the wave 4. Well, pardon our inaccuracy. We can't know, of course, everything beforehand. But we did get, of course, this nice rally. And we're now most likely in this larger wave 4. Allow me to explain. All right. Why? Because after 4 comes 5 and after 3 comes 4. Very simple. So there will also be a larger fifth wave coming, which we believe will target 8,000 plus. This bull market is not over, not in a long run, but we probably need to take a step off the gas and be more prudent in how we trade. So let's have a look here at how things have transpired to the downside. So we had this wave 4. Ideally, we would have liked to see 7,200, 7,300. All we got, I think, was about 73.33, somewhere out there. And then this nice rally, impulsive rally to the upside to 76.20. Again, only 30 points away from our May 18 update. That's pretty darn accurate in my humble opinion. And here we got what looks like a 3-wave bounce. So that looked like the or rally that looked like the initial bounce we forecasted. Remember here that we were looking for this bounce and then lower. But what the market did was instead subdivide higher as a ending diagonal fifth wave. Ending diagonals consist of an ABC higher for 1, an ABC lower for 2, an ABC higher for 3, and then most of the times an ABC higher for 5, sometimes a fifth wave higher. Ending diagonals don't have to be only 3s. All right. If you follow our Elliott Wave, you would take my course, you would learn that this market does not stick to standard patterns that have been posted in book by Frost and Proctor about Elliott Wave and ending diagonals. Why? Because ending diagonals have now morphed into other patterns that Mr. Elliott did not have data for. We have 100 years more of data now than Mr. Elliott did his Elliott Wave theory, which now is a principle. The theory has been proven, and we found that there are ending diagonals or leading diagonals that do not adhere to the standard patterns. They're either shorter, they're either longer, the retrace is not there. Market decides what it wants to do as long as it, of course, has followed the rules. In this case, wave 4 doesn't overlap with the end of wave 2 or etc. All right. That aside, please remember ending diagonals do not have only to be 3s. They can be different. Same for leading diagonals. Leading diagonals do not have to be 5-3, 5-3, 5. Okay. I can give plenty of examples in the current bull market where the leading diagonal was way different. So anybody who thinks that needs to be according to the book, you need to read up or follow my Elliott Wave course. That said, we got the fifth wave lower and we're now in our our larger correction most likely. So I want to share some posts on X. You definitely have to follow me on X to get the latest insights, which are always after the fact. The true latest insights, of course, when you sign up for our daily newsletter. And I'll show you in a moment where we think the market is and how we have forecasted it. So this is my account on X at Intel Invest. And here we're going to go over what we posted on June 5th. All right. So on June 5th, this is already posted before that, and we'll show you exactly what transpired. So we forecasted every turn at 76.20. The S&P 500 came within 15 points. We had really downgraded the upside target a little bit from our May 18th forecast. And that's what you do. You anticipate, you monitor, and you adjust. All right. When then the final waves are starting to become a little bit short, you adjust accordingly. And again, the target zone from 2 weeks before that was adjusted 76.35, 77.05, but we got into the June 2 to 4 timing window. I told my premium members that the timing for a top was June 2 to 4 based on new information that became available to me. So then in Wednesday's newsletter, which was the week before this post, we said if we see a lower 5-wave decline, we'll get a bounce to 75.95 and then another drop to 74.90. What did we get? We got the next day a lower low, 75.16, and instantly the bounce to 75.98. And then the market was trading at 74.45. So also there, even exceeded the downside target. So we had what we call a 5th wave failure. Yes, it made a new all-time high, but didn't really reach its full potential. And most likely a larger top is in place. Here is a screenshot of our newsletter where we exactly said that would happen. All right, you can see here a little bit what we were looking for, a little bit lower. That's what we got on the open the next day. And then a rally. Fantastic. The bounce to 75.95 plus or minus 10. We got 75.98, followed by this wave 3/C, because we don't know if we're going to see an impulse yet. 74.90, 70 plus or minus 30. And that's once again exactly what we got. And we are now, of course, going to look for lower prices one more time. Then on June 12th, I reposted once again the next step we looked for. We were looking for a bigger bounce. All right. We were looking for a bigger bounce, an A, a B, and a C, as you can see here in blue. It's maybe a little hard to see on your screen. That's where you get where you don't read our newsletter. And we said a wave A to ideally 73.80, 74.30, a wave B to 7300 plus or minus 25, and a wave C based on the information available back then. All right. So this is already early June, and we're of course way into June by now, to 74.65, 75.30. All right. A, B, C, just very standard Fibonacci extensions, retraces, all that stuff. And then the market can decide if it really wants to listen to that. So what did we get? Well, we got there, right there. This is the target zone, wave A. This is the target zone, wave B. Top there, bottom there, slight undershoot, but nothing too dangerous, right in the margin of error. And we were already rallying. So back then, we could already think that the correction was complete, meaning this is a corrective bounce. Well, the market tagged on a little bit higher. We got 75.65 when we posted the update, and I believe the market went to as high as 75.80 this week. Okay, so once again, very close to what we were looking for. We were looking for 74.65, 75.30, off by about 50 points. Not too bad considering where we were back then. All right, we had not completed any of this stuff. All right, so we were right there. This is where we forecasted 74.65, 75.30. Well, we almost did gap fill here on this gap down, the wave 3 down, and you can see we're tracking here a potential 5 waves lower. Okay, that's what we're looking for. Hasn't been confirmed fully yet, but so far so good. So we got the bounce. So it's all been according to plan, right? We got the 4th wave, fell a little bit short, didn't subdivide as we anticipated. We got the 5th wave, Okay, fell a little bit short of the ideal target, but again, we're only 15 points away from where we adjusted the target to while this, of course, rally was going on. As the rally matures, we adjust our price. We're not rigid, okay? We're not saying, well, because you said 10 years ago that this will go this high and it didn't. That's, of course, silly. It's the same as the weather forecast. If the weather forecast calls for rain on Thursday, by the time we get close to Thursday, and the forecast has changed to rain on Friday, we're not going to bring our umbrella on Thursday. We're going to bring it on Friday. Why? Because the data changes. As the data changes, we change accordingly. We're not rigid. We are fighter pilots. All right. If you're a fighter pilot, what do? You anticipate, you monitor, and you adjust based on the data that becomes available during your flight. If you don't adjust to the new data becomes available, you'll crash your plane. Very simple. So stay rigid, fine, you'll crash your plane, you're good. Follow, adjustable, very accurate, very reliable, Elliott Wave, you'll get there. You get most of the gist, I would say 80% of the moves correct. There are times we're wrong, then we simply adjust and go back to the drawing board. We're not saying we're right all the time, but with this, you can be pretty darn accurate. We've nailed pretty much every single turn since mid-May. This is I find it absolutely fascinating, absolutely amazing. My personal trading account is doing wonders. Though I must say I'm trading very quick, very small, because I don't like the market it's in. I prefer bottoms that we had, for example, in March of this year, which are way better, higher confident calls than the current slop we're dealing with. All right, so that's where we are right now. So everything has been according to track. So where does that leave us now? We believe the market, as you can see here, is in this second wave, and we're going to see a 3, a 4, and a 5. We have our warning levels. Of course, if we go above yesterday's high, this is not a second wave, but so far we've reached once again this target zone. I would have liked to see less of a gap up, but more of a little bit of a drop at the open and then a rally throughout the day, just as we saw here in early June. It's a fantastic long opportunity when you say gap down and then rally and then gap down again. That's fantastic. That's a fantastic trade opportunity. We didn't get it today. This is just slop. It just gapped up at the open and so far in the ideal wave 2 target zone. Again, I'm talking about the S&P 500. I'm not talking about the semiconductors. They're in a different wave count. The Dow Jones is in a different wave count. The NASDAQ 100 is closer related to this wave count. So each index needs to be treated on its own. So it gives us plenty of headache and plenty of work to do. So that's one of the reasons why this update, of course, has lasted a while. But you can see here, again, the gray target zones are what we forecasted for wave A, for wave B, and this wave C. Why is the C wave target zone so large? Because we don't know beforehand if the C wave will equal the length of the A wave or if it will extend to most likely 161.8 times the length of percentage times A, 1.618. We got 2 times. I cannot know. Nobody can know. It will decide to do 2 times the length of A. Fantastic. Good. Well, whatever. That's just the way, unfortunately, it is. But you could already see here on Friday last week that we were in the target zone. I personally just closed my positions and that's it. I took a little bit of a loss on a long and that's it. Had I hold till Monday, coulda, woulda, shoulda, I would have had a fantastic trade and I would be up fantastically. But back then it was already in the target zone. You're a little bit down on your position. Then you should, I think, close your position and say, hey, this is maybe going to top. I bet you if I'd held it over the weekend, of course, the market would have gapped down on Monday. So is it? There's always a new bus to catch. Then, of course, you trade some puts here on the down. All right. So you're making up. So I'm still up for the month and I'm still up for the week. I am not complaining whatsoever. Losing trades are part of the game. Anyway, we're now looking for a steeper decline to the low 7,000s. That should then complete 3 waves lower on a bigger time frame. We have A, we have B, we have C. Again, normally we will see a 76.4 to 62% retrace. We overshot it a little bit, essentially almost closed this gap here. And we should now move lower. Can this B wave 2 here in green subdivide? Yes, it can. It can do a lot more than what we've just seen. This could have just be A of B. Now we're in B of B, and we're going to see another leg higher, C of B. So ultimately, of course, we need to break at least below yesterday's low, and especially, of course, below the early June low to really confirm that the larger green wave 3/C is underway. Why do I label it A1, B2? Because we don't know if we're going to see 5 larger waves lower or only 3. Most likely 3, but we could get 5. I can't predict the future. I am simply tracking the price action. And so far, the market has done quite well with that tracking and what we expected to see for over a month. That always gives me a little bit of caution, my friends, because sometimes you go, I've been right quite a lot with, of course, some margin of error. I'm not saying we nailed everything to the T. Again, there was a little bit overshoot here for wave B. There was a little bit overshoot here for wave C, but we got the magnitude correct, of the direction correct. Not necessarily always exactly the magnitude, but if you get the direction correct, you can directionally trade. That's all that matters with trading. Does it matter if it goes to 75.80 instead of 75.30, which was forecasted about 5 turns before? No, it doesn't. You adjust accordingly. And then you'll just see like, okay, it's adjusting. You don't have to catch every single move. I didn't catch Monday's move. All right. Well, for put side, I eventually decided to short this thing, just go long some puts, and it worked out tremendously well. Now we're going to see if we get these 3 legs lower, yes or no, on a bigger time frame. Regardless, case in point here is that we have expected the 4th and the 5th wave, the gray 4, the gray 5, and they did complete. And now most likely a larger full 4th wave is underway. The larger 3rd wave has likely topped in our timing window, June 2 to 4, topped exactly there. And this correction will, of course, be quite difficult to track and trade. That's the narrative of a 4th wave. Lots of confusion, lots of up and down, just as we've seen so far before, right? Down, up, down. Very confusing for a lot of people, but you can still forecast it quite well if you know that we are in a larger 4th wave. You have to look for ABC patterns. That is your go-to pattern, and then you will see how they will exactly fill in. Sometimes we get a CSA, sometimes we get a 2 times CSA. All right, it happens. It's fine. If you forecast 75.30 when we are at 7,400 and you get a 75.80, I think you've done a pretty darn good job. So that's where we are right now. I think we've nailed most of these turns accurately since the recent all-time high and before. Can't state it often enough. Please like and subscribe our channel, and please, if you really want to get the latest insights on a day-to-day basis, subscribe to our newsletter. The first month, 50% off, $50. It's less than 5 cups of coffee. What do you have to lose? We've nailed it since at least May and before. This bull ain't done. Thank you so much for following us. Take care, trade safe, and we'll catch you all next week.